Good afternoon and welcome to KPMG's LinkedIn Live. Today's discussion features Peter Torrente, KPMG's National Sector Leader for Banking and Capital Markets, and our guest, Tom Michaud, President and CEO of KBW. KBW, an investment bank focused on the financial services sector, is a subsidiary of Stifel Financial. KBW's highly regarded bank research team has the broadest coverage of the banking industry on Wall Street, covering not only the nation's largest banks, but most of the leading regional banks as well. And now for our presentation.
Tom, welcome. Great to see you again. You know, we were talking last week, we were saying hard to believe the 4th of July is behind us already, but here we are with second quarter earnings season kicking off. And while the environment certainly continues to improve, what do you see as the positive narrative for the quarter? And what do you see as some of the challenges facing the industry as well?
Well, Peter, great to be with you and your colleagues as well. I think there are going to be a couple of key stories that play out this quarter for the banking industry. First of all, it's going to be recognition again about how strong the balance sheets are. The industry continues to operate with 80-year highs of capital. The credit quality has really been exceptional and I think somewhat of a surprise. We still believe that the industry is very well reserved for what we see on the horizon in terms of credit costs. One of the challenges is what's happening with core revenues. The earnings per share that the banking industry reports this quarter is going to be fantastic because we think that there'll be about 20% of the industry that reports negative loan loss provisions. But from a top line revenue growth perspective, we're really not looking for much revenue growth linked quarter. And I think that's going to emerge as the key dialogue for what is happening in the banking industry today. And there are a lot of key dynamics as to why that's the case. One is investment banking is going to be down linked quarter because of the great peak we had in the first quarter. But the core part of the business for most banks, which is net interest income, continues to be under pressure because net interest margins are a little bit lower. The industry's got a tremendous amount of liquidity from all the support programs and hoarding of cash by many banking customers. And I think that's going to be the big conversation about what's happening in the quarter. And then the third big angle is when does the market really think this might change?
And Tom, maybe drill into two things there if we could. I think credit, certainly, I think we're seeing and hearing that as well from our clients, continued decline in provisioning and reserve releases for the second quarter. I know in past quarters when we've talked a little bit about the worst case scenario being off the table, I think is the way you phrased it. Do you think we really have the credit scenario behind us, or do you think it's temporarily paused given the stimulus?
This cycle's been remarkable with how well credit overall for the banking industry has stood up. And I think there are a couple of reasons for that. One reason is that since the last time we had a crisis, the global financial crisis, I really think the banks have upped their game. And I also think the regulators have applied a lot more oversight. And so I think the industry from a credit underwriting perspective was probably in better shape for a recession than it's almost ever been before. So I think some of that is that, like I said, I think the industry's upped their game. And then when you look at the government's response, not only in the United States, but around the world to this crisis, it's been to flood the market with liquidity. And what that has done is it's given bank customers a chance to refinance when they might not normally have refinanced. And so I think that that's helped the credit as well. And then there's been another piece, which is the customer's attitude. I mean, if you look at the consumer part of the economy in the US, increasing savings was one of the initial responses of the consumer in the United States. And that's put the consumer in a really good position, which is a sizable portion of the banking industry. So I think there are a variety of reasons that make me optimistic that this credit cycle is going to last as a good one. Now, we do think that net charge-offs will go up, but they're going to go up off a very low level, a very, very low level. So they're still well below historic periods, even when times are good. There's no reason to believe they wouldn't go back up to what is the historical net charge-off rate for the industry. But I don't think that once these government programs stop being as robust as they are, that all of a sudden you'll see an opposite effect in credit quality in the banking industry.
Tom, maybe the other area is you touched on the rate environment, and it seems like if we were doing this interview a month ago, we would be maybe talking about inflation fears, and maybe more recently that has abated. How do you relate that to the banking industry?
The industry has not recaptured all its profitability back from like the 2018 period. We've closed a lot of the gap, but not all the gap. And the big difference maker is net interest income. So it's the fact that we've had lack of loan growth and lower rates has been the real pressure. And our analysts are forecasting two rate increases by the Fed. We're looking for one in December of 2022, and we're looking for another in June of 2023. And so that's really, as we get into 2022, and then when the rate increases start kicking in 2023, is where we look at a lot of the gap in profitability from where we are today to where we were back in 2018. That's sort of the period where we look for the gap to close. Remarkably, the market has taken a very different view. If you were to just look at the yield curve today, you would think that the market doesn't believe that inflation's going to come on, and that it's not only transitory, but it's really transitory short-lived. My view is that I don't have as much confidence in today's yield curve because of the amount of extraordinary liquidity resources that have come to bear from the central banks around the world. When you look at monetary policy around the world, you look at fiscal policy in the United States, it really leads you to believe that we're in a little bit of an artificial moment, which personally leads me to believe that we might get a little bit steeper curve. The Fed should go on and increase rates like I just laid out. That is generally the market's expectation, I believe. And when that happens, we believe the industry is ready with a significant amount of liquidity and capital to be able to put the money to work for their clients and also improve earnings at the same time.
How long do you think the current operating environment lasts?
Our view is that we could be in a sluggish revenue environment at least through year end, is what we think, because we forecast without a change in rates that there'll continue to be a decline in the margin. We've had records amount of liquidity in the system. And so our belief there is that it'll take a while to burn that off. So as we talk to the banks, we're starting to see incremental signs of improving loan growth, but our sense is that it's going to take a couple of quarters to build up steam. And heck, you look at GDP growth in the United States, the economy is picking up momentum, and that really ought to help the industry get to a point where you can see more growth again in loans, which is really probably what you need to break out of this operating environment.
And given that environment, what do you see maybe as the operational and strategic imperatives or actions that CEOs need to take to kind of navigate through the next couple of years?
I see a continuing drumbeat on focusing on expenses and efficiency. It really is remarkable and how intense I believe that is, because if you're not having a lot of revenue growth, and there is some inflation in the economy right now, whether it's transitory or not, if you want to grow net income and earnings per share, you need to do a couple things. You need to focus on expenses. And also it's happening at the same time when technology is really standing up and I think starting to help the industry with its cost structure, possibly take expenses down a notch. And so I see more banks adopting technology to help them be more efficient. And that can include just sort of internal technologies or more customer engagement where you need fewer branches where there's a lot of cost in the system. So I think internally managed expense programs continue to be a strong theme. The second thing is consolidation. When two banks come together, when they're both of near the same size, there usually is a lot of cost savings opportunity, which can make these banks more efficient, which could help that improve their fundamental results, but also allow them to be able to stand up and make further investments that might be needed to go on and achieve their goals.
Tom, maybe wrap up with a final question around the regulatory and tax environment. I know we're talking to our clients a lot about those two areas, and just maybe one, do you see a big impact on the market to those potential additional costs that seem likely? And then two, maybe tying back to the M&A activity that we've seen over the last 12 months and that you just commented on, do you see some of the comments coming out of Washington last week slowing down that trend at all?
I think it's pretty clear that this administration wants to take government oversight around consolidation up a few notches. And the president's executive order several times mentions the financial services industry. I believe anywhere from 180 days to 270 days, the president has asked for reports to come back to him about the current status. And my sense is that while those reports are being worked on, and then once it's done, the amount of scrutiny is going to go up. So I couldn't see how that doesn't slow the process down. So I don't think it's going to stop it, because look, the banking industry's been consolidating since the mid 1980s when the banking laws were followed. And I also think that over time, with regards to consolidation, if you really look at the numbers, you're going to see that the big banks in the United States need more big competitors, not less. So just to give you the numbers, 4 banks in America essentially control 40% of the deposits. These banks their growth rates were enhanced during the global financial crisis, when the FDIC's policy and strategy was to take big failed banks and give them to even bigger banks. So we kind of set ourselves up on this path a while ago. And if bank consolidation were to stop today, those 4 banks would probably be enshrined as the big 4 players that we'll likely have for decades. What I think needs to happen is we need to have more bank consolidation that allows the big banks to have more competitors. And that's just within the sphere of the banking industry, because now we're seeing companies like PayPal, which owns Venmo, have market capitalizations that, if they were a bank, would make them a top 5 bank in the country. So you're seeing the fintech industry really come on strong, especially after the COVID period. So when you think about the dynamics for what customers are going to have for choices and thoughts around consolidation, you have to decide which market are you talking about. Are you looking at just within the banking industry, or are you looking at the banks also, how they stand up relative to non-bank competitors like fintechs and shadow banks? My sense is that industry will slow down, but I think it'd be hard pressed to see that it's going to stop, because I think it is still actually working in many cases in the consumer's benefit to have more of these bigger strategic players stand up. With regards to taxes, the general assumption is that corporate tax rates are going to go up some. President Biden was very clear in what he laid out for his tax plan. The sense is that somewhere between where rates are today and the president's proposal, somewhere in the middle is where you'll see corporate tax rates fall out. Even though we haven't changed our estimates to assume any of that, and that would be a direct deduct from bank profitability and all corporate profitability. But our sense is that if it was a mild increase, that the market's generally expecting that.
Thank you again for sharing your thoughts with us as we go into the next couple of weeks. Really appreciate it, and really look forward to seeing you again next quarter.
Peter, thank you very much. Be well.